Hi, everyone. This is Jason Barack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a first-time guest, but he comes highly recommended from one of my oil industry contacts down in Texas. It is Dan Steffens, who is president of the Energy Prospectus Group, which is a networking organization based in Houston, Texas. Dan puts out a very good oil and natural gas investing newsletter, and I'm excited to have him on to talk about the oil and natural gas market. So thank you for joining us on a Wall Street for Main Street podcast, Dan.
Yeah. Hey, Jason. How's it going?
It's going good. Now, Dan, before we talk about individual oil companies, let's look at the macroeconomic view of oil, the 30,000 feet view of the oil market, supply and demand. It seems the shale oil boom has been amazing for the U.S., but we still have oil prices around, $100 a barrel WTI. Brent crude's even higher than that. What's your view of what's going on in the oil market right now?
Well, one thing, when I go talk to groups, the first thing I explain to them is that the oil market is a global market. It's not a regional market like natural gas. And I think the fear, I saw a lot of this fear last year when the shale plays were ramping up production. They thought that the shale oil plays would do the same thing to the oil price that the shale gas plays did to the natural gas price. But natural gas trades on regional markets, and because the U.S. really has very little import-export capacity for natural gas. We're oversupplied right now in the gas market, but oil moves pretty freely throughout the world. And since we're still a net importer of about 7 million barrels a day, we are, we're victim to the global price and the global supply and demand. So that's why oil's staying high.
Yeah, that's a good point. And another thing about the global oil market on the supply side is that the national oil companies control the majority of the world's oil reserves and oil production still. It's
right.
Not, ExxonMobil or Shell or BP who control the majority of the world's oil production. Saudi Aramco and Iraq and Iran and, the Russian oil giants there, the oligarchs like Rosneft.
Mm-hmm.
And, these guys, they're not all reinvesting all their capital, especially efficiently, into finding more oil production and new technologies and things like that. A lot of these guys are not really investing in their oil stuff at all. They're spending so much money on social programs and stuff that the profits are not being prudently reinvested into, finding new supply, lowering costs and things like that.
Yeah, that's true. Really, if you look at the BP report, they do an annual report with a lot of statistics in it, and I looked through them. There was 48 companies included in their statistical report, and there was only like 9 countries that had production growth. I mean, if you took out the U.S., production grew like by 1.1 million barrels per day, but if you took the U.S. out of global oil supply, the rest of the world combined was on decline by about 500,000 barrels a day. So it's the U.S. and Canada are the only 2 countries that over the last 5 years have had any meaningful production growth. The rest of the world is pretty much flat to down. And like you said, the shale boom is going on in the U.S. because we've got the infrastructure and we've got, private ownership of minerals, which is the reason it's growing is because of the states of North Dakota and Texas that are very friendly to the oil and gas business. And so and the infrastructure was already there. The reason Eagle Ford, North Dakota, Permian Basin are growing is because there already was a lot of service companies already, a lot of pipelines and stuff. So they had all the frac crews and the rigs. You don't have that in the rest of the world.
That's a great point. And also the geology for a lot of the shale oil plays in many other areas like Argentina and China and the Ukraine and also Poland seems to be a lot more trickier. We've seen that, with the California Monterey Shale, how the geology is much more difficult, and then you add in all the environmental rules and regulations. But, you pointed out the other countries not being able to grow production. We saw Iraq grow production really after the U.S. occupied it, but now you see the geopolitical problems. That's another thing with oil is normally in a lot of these countries outside the United States and Canada and Mexico really, outside of North America, there's a lot of geopolitical turmoil involved in oil production. So any hopes, of Iraq doubling their oil production, which I know the Iraqi oil minister was saying prior to the news that we're seeing coming out with the ISIS rebels and stuff, I think the odds of that are low.
Yeah, every long-range production forecast I see is depending on significant increases of production from Iraq. And now I don't see that happening at all. I mean, even way they have triple the growth in Iraq that they have in Saudi Arabia projected, and I just don't see that happening. Now, I mean, who's going to invest heavily in Iraq and Iran now with this stuff going on? So, yeah,
Just
it's going to be an interesting few years ahead. I sure wouldn't want to invest in any deal over there. So.
Yeah, I completely agree. I think it's going to be most of the foreign investors are just going to be the Chinese, because the Chinese, have the military backing it. I don't think you're going to see private investors, regular Americans or Canadians or something, be willing to risk as much capital. But the Chinese have so much dollars and U.S. Treasuries that they want to dump that they're going to, and they have the military, their own humongous military backing them up. It'll be gunboat diplomacy type of thing, from old history books, with the British Empire or the U.S. in the past.
Yeah, and we've got enough investment here in the United States in shale plays to last for a few years. It'll be quite a while before these things get fully developed, and the rate of return on these wells is incredible. So.
Okay, well, let's talk about the shale oil wells. One thing that we've seen recently, the last 5 or 6 years, is capital expenditures in the oil industry is booming. They're going up a lot. So just to keep oil production basically flat, we've seen demand, as you mentioned, from the BP statistical review. It is growing faster than supply, but the U.S. is in a really good situation here where we have these amazing entrepreneurs. I read the book The Frackers. I don't know if you've read it. It's a great book about guys taking a lot of risk with their own money. And, the big oil companies, they had these shale oil deposits, but they didn't think they were economic or could be done. And these guys figured out, these smaller guys, independents, figured out how to get the shale out of the ground, either oil or natural gas in the Eagle Ford and the Bakken. Do you think this is sustainable for longer than the EIA projections then?
Yeah, I think it's quite a bit sustainable. Actually, there's been a lot of progress this year because they're using a lot more frac sand in these wells, and they're getting great results. I just looked at SM Energy and Whiting both reported that they're using a lot more sand in their wells, and they're getting much, much better economics, getting higher IP rates and higher sustained rates, which will give them, ultimate recovery should be a lot. The one thing you pointed out is that it wasn't the majors that really pushed hard on these shale plays. It was a lot of companies that you really didn't hear about. I mean, you go look at Continental and even Whiting and EOG Resources 5-6 years ago were a lot smaller companies, and they're the ones that kind of took the big risk. And a lot of our members are guys that have decades of experience, engineers, geologists, And I can remember them telling me 5-10 years ago that, no way these shale wells, no way the oil shale wells will work. And so it was this old mentality thinking, and it really took some more, aggressive entrepreneurs to really get the thing going. Because you really don't see the majors in the shale plays. The biggest producers in the shale plays are not the Shells and Exxons of the world. They're, the EOG is number one, the Eagle Ford, Continental Resources, and Whiting are the two top companies up in the Bakken.
Now, do you think that's going to change in the future? Do you expect like ExxonMobil and Chevron and BP and these guys to come in and maybe overpay for some of these guys in the near future with big acquisitions? Mea culpa, my fault. We screwed this up, and just buy the existing already producers in there? Or do you think they're going to try to come in late maybe and go move into maybe the next shale play, maybe the Permian or one of these other future shale plays, and try to get ahead of the groups of independents?
Yeah, they might. I keep waiting for that to happen. I've been saying that for the last 3 or 4 years. I keep waiting for the majors to come in and start buying some of these independents, but it hadn't happened yet. Whiting just took over Kodiak Oil and Gas, and I don't know. They could. I mean, they're sitting on piles of cash, so I guess they could. Now, Exxon has got their XTO subsidiary up in the Bakken. They're one of the bigger players up there. And the one I see, Conoco and Chevron are down in the Eagle Ford, got pretty good stakes. Hess is up in the Bakken. They got a pretty good stake up there. So there's, some of the companies that you've heard of, but the really big multinational E&P companies and majors are not in these plays as much as you would think they would be.
Yeah, they seem to not be. They seem to be putting most of their oil exploration dollars into deep water in South America, Brazil area, or Gulf of Mexico, maybe moving into Mexico now that Mexico has opened up, or Western Africa or Asia. And they're really heavily investing in natural gas and LNG and things like that, but I don't know, maybe it's the management teams. They don't want to admit they made a big mistake, and they're just trying to pretend that investors that they didn't make that big a mistake, and they're trying to ignore it. But it just seems like real complacency there that, if I was them, I'd be going in and buying a couple of these companies and saying, you know what, we screwed up, but we need a presence in these plays because there is growth here, and we're going to be able to grow production, and it's safer in the U.S. as opposed to another country where they can raise taxes or cheat you out of your deposits, like I think what has happened with BP in Russia or Shell in Russia.
Yeah, Jason, I think you hit the nail on the head. They don't want to admit they made the mistake. And once they build their economic models on something, it's hard to get them to change it. So, I used to work for Hess, and I could tell you they were late to the party in the Eagle Ford, and then they got second tier acreage, and then they ended up selling out the Eagle Ford. The only reason they're in the Bakken is because they already had significant acreage up there held by production right in the heart of the play. And the one thing now is, and the Eagle Ford is like 7 million acres, but the tier one acreage is probably only 1.5 million acres. It's in all these plays are huge, but there's the sweet spots, and then there's a second tier and tier three, and some of it, even at $100 oil, the second tier acreage is still pretty good, but there's still a lot of that acreage down there that you need almost $150 oil to justify drilling in it. So with everything tied up now, they would have to pay up. They'd have to pay up big time to get into those plays because these things aren't going to go cheap. So.
Yeah, I would agree. And the whole cost structure of most of the oil industry, and yes, we've seen some entrepreneurship with new techniques, new fracking techniques, and we're seeing like these every couple months. We've had these octopus drilling pads that have been installed, I think, on these shale pads, right, where they put one humongous oil derrick, a big octopus, and the thing can literally move with robotics, right? It's like a four-cornered pad, a big rectangle. It can move from one corner to another, and then it can drill dozens of wells in just one area. It's really amazing the amount of technology and innovation that we've seen. I think that's what a lot of people have not understood is how much entrepreneurship and innovation and supercomputing technology and stuff that has gone into the resource industry in the last decade or two.
Yeah, I will tell you that everybody talks about fracking when you go around and ask me about fracking. Well, fracking's been around for 60 years. We were fracking wells a long time ago. It's the horizontal drilling technology that's just absolutely amazing to me. The fact that you can drill wells down to 10,000 feet and then drill sideways for 2 miles, 3 miles is just incredible. And then they're putting now these 30-stage fracks on these wells, and they're using smart fracks. Halliburton's come up with a new logging tool that they do a detailed log of the horizontal section, and they can break up the horizontal section into different pressure zones. So you can do what they call a smart frac, and because your frac, when you frac a well, it's going to go to the frac sand is going to go into the area of least resistance. So if you frac a section of it and part of it has more porosity than the other, it's all going to go in the lower porosity area, or the higher porosity area, and you'll lose that, and you won't really get any effect in the tighter zone. So they can do a smart frac across there, and that's going to really increase production from these wells. You mentioned how many wells are drilling from a certain pad, and it's really cutting down on their overall cost of development. If you look at Continental Resources, they're talking about now drilling 32 wells per pad up in the Eagle Ford, and they're going to have stacked wells of 4 wells stacked on top of each other, and 4 wells in each zone. And you've got the Bakken, and then you've got the Three Forks as 3 productive zones. So they'll have 4 levels of wells and 4 going sideways. So you'll have 16 wells going one way 2 miles, and 16 wells going the other way 2 miles, and they're all going to be completed to one pad. Now think of that. These are wells that come on at like 1,500, 2,000 barrels a day. So you can have 50 to 60,000 barrels per day of production come into one location, and then you've got to have all that processing facilities and everything. It's really equivalent to what they have in the big, giant offshore platforms. We have that much production. You've got to separate the water from the oil and the gas, and all the liquids have to all be separated. And it's with such volume, you're not going to be able to truck that out. So you got to have pipeline connections and everything. So it is really a major investment each location up in these plays now.
Yeah, I think there's going to be a lot of. I know you cover upstream companies, actual producers of the oil, or people who are going out there finding the oil. But
Yeah.
I think there's also a lot of opportunities as well in Halliburton, like you said, and the infrastructure companies, the companies that are going to have to build those extra pipelines to areas, to new shale plays that were maybe not thought of as very highly in the past, or things like that. But in terms of the shale plays. Do you still like companies in the Eagle Ford or the Bakken, or do you think the valuations are pretty frothy on those at this point?
No, I think they're really good. In fact, probably most of the companies we recommend are the shale play companies.
Now,
go ahead.
Now, in terms of some of those companies you have in your model portfolio, you have a Sweet 16 list of companies here. What are one or two of the companies you like that are already producing that you think offer good value and maybe some good growth and have a really good management team?
Well, one I just looked at the other day, SM Energy looks really strong, and I think it is grossly undervalued. It's trading for like $80 a share, and I'm coming up with about breakup value of like $160 a share. They just report outstanding quarterly earnings, and they're in the Eagle Ford, they're in the Bakken, and their production and cash flow is just incredible. I mean, it's an $80 stock. They're going to generate over $22 a year this year in cash flow. So trading at like 4 times cash flow is pretty ridiculous for a company with that much upside. And it's kind of one that's off the radar screen. Its symbol is SM, if your listeners are interested. And the other one, I think Whiting's going to get a lot of attention. Their merger with Kodiak makes them the number one producer in North Dakota when that merger closes. And I compared them to Continental, which was the previous number one company, and their ratios look a lot better than Continental. So I think when the analysts all sit down and start really exploring that, they're gonna see that Whiting may be the better value. But Continental, I mean, it's a first class company too.
Yeah, Kodiak Oil and Gas is an interesting company. I actually bought that after the 2008 crash. I bought it $2 a share. I didn't know a lot about the shale plays, but I was looking at their drilling results. I just started to learn a little bit of resource investing and geology, and I saw like the undervaluation there in terms of their reserves. The market wasn't valuing it at all. It didn't believe in the shale play story. I got it up to $6 a share, but I didn't know how much growth potential there was. So obviously it's gone up a lot since then. But
yeah, Jason, you do what everybody else does. Who really rides these things all the way to the top? When you got a triple in it, it's hard not to take that gain. But a lot of these have really made incredible moves. If you look at Gulfport Energy, that was one we recommended at about $3 a share, and it's trading for like $55, $60 a share. And I still think it has upside. The growth of some of these companies has just been absolutely incredible.
Now, in terms of other shale plays, we talked a little bit about the Eagle Ford and the Bakken. You think there's still growth there. I've heard experts talk that they think the Permian Basin is bigger than the both of those two combined. What's your opinion of the Permian Basin going forward?
Well, the Permian Basin, it's really stacked plays. Where they're having a lot of successes in the Wolfcamp, and it's really not a shale play. What they're doing is they're just applying horizontal drilling to the Wolfcamp. And think of it as just a tight sand. It's really tight. So by doing the horizontal section, you open up more of the zone. And then with the big hydraulic fracks, they can crack that zone open and get a lot more out of it. You drill, we drill a lot of Wolfcamp wells when I was at Chess. And, if these things came in at 50 to 100 barrels a day, you were, thought it was pretty good. But they're completing these things for 1,500, 2,000 barrels a day out in the Permian. A company out there that we really like is Concho Resources. Its symbol is CXO. Of course, Pioneer is the one that gets a lot of headlines out there, and that's doing good. And some of the smaller companies, let's see, who else on this list here? EOG Resources, which is number one in the Eagle Ford, also has a pretty significant position out in the Permian Basin.
Yeah, and also doesn't ConocoPhillips, they're pretty big out in the Permian, right? And Devon Energy, I think, is another big player out there. They've had to transition, though, from natural gas, shale gas, to more oil, right?
Yeah, in fact, we just added Devon Energy to our Sweet 16 growth portfolio, and it looks good. It looks really good. And yeah, Devon's a first-class company. They're kind of known in the market as a gasser, but if you look at their transition in the last couple of years, they've been focused on the liquids production, and it's really coming up. And I think there's a lot of upside in that stock. That symbol is DVN if people want to look at it.
Now, in terms of free cash flow for these shale oil and producers, Bloomberg came out with a study recently and said that for some of them, maybe it's the more smaller, inefficient companies, that debt is growing much faster than revenue and earnings. Is that not the case with a lot of your Sweet 16 portfolio, that these guys are a lot more efficiently managed and have better balance sheets than some of these other shale oil producers that are, borrowing cheap debt and running up debts much faster than revenues?
Well, when you look at an E&P company, you really don't need to look at the past. You can look at the future. And if they're building their proven reserves faster than their debt, then they're deploying that debt correctly. I mean, if you're building the value of the proven reserves 4 times faster than their debt, well, heck, get all the debt you can at today's low interest rates and go build it up. I mean, most of these companies, you are outspending their cash flow, but the reason they're doing it is they're tying up acreage. You go out and get an oil and gas lease, and you may only have it for 3 to 5 years. Well, you have to drill it, and you have to establish production to hold that lease. So they have to go drill and keep drilling to hold their acreage. But then once they prove up those reserves and they're producing, they hold that forever as long as they're producing it. So they got to do that. But what really is the value of any E&P or upstream company is their proven reserve base and their projected growth of what they have in their acreage.
Yeah. Yeah, I would definitely agree with that too, because I've listened to a lot of resource CEOs and executives speak, whether they're gold, silver, oil, natural gas, and the main metrics they use for valuing their own companies or making acquisitions is production growth and reserve growth. That's what it comes down to. Either you're growing or you're not. So, and that's the thing about the resource industry is you have to replace reserves, and we're not really seeing replacement of reserves with the larger companies. ExxonMobil and these guys, they're transitioning more to natural gas. They're not replacing their oil production or their oil reserves. And, it's just good for the United States in general. I think the shale oil boom has prevented the U.S. from collapse. The U.S. is in a really bad financial situation, but the shale oil boom has really saved the U.S., from our trade deficit and, created a lot of jobs all throughout the supply chain.
Yeah. I tell you, I drive over to Louisiana probably about once a month. And you drive over Highway 10, which goes all the way across the United States. And if you count the number of flatbeds hauling pipe that are coming from the U.S. steel mills into the oil field, it is incredible. And there's a lot of offshoot industries that feed off of this. In fact, I can't even imagine where the U.S. economy would be without the energy business.
I think it would collapse.
Yeah, it would collapse. And this is the one thing I always tell people. This natural gas boom is God's gift to America. Our low energy costs, because we're paying about $3.50, $4 for our gas here. Well, it's $10, $11, $12, in Europe, and $20 in the Asian market. So our cheap energy, our cheap and abundant and consistent supply of energy offsets cheap labor in these other countries and is bringing a lot of industry back to the U.S. The petrochemical business along the Gulf Coast is just booming, and we're going to see a big increase in demand for natural gas and natural gas liquids in the next couple of years as there are billions of dollars in capital is being spent down here to build these plants. And, that's where all your plastics come from. You can look at almost anything around your house, and there's oil and gas or minimum a lot of energy in it to make it. So brings a lot of industry back to the United States.
Yeah, and it's been bringing back those more automated factory jobs. So you combine the oil boom with Silicon Valley and all the gains in software and automation and robotics, so cheap energy plus robotics, and now you have a modern factory like a Tesla factory or a Volkswagen factory where in the past there might have been 5,000 or more human workers putting together a car. Now there's 500 workers or less with a whole bunch of robots. They're running the robots. They're getting paid higher paid jobs. This is how free market capitalism is supposed to work, instead of all these other interferences by politicians and bureaucrats and things like that. And it's just amazing that the hardworking shale oil entrepreneurs have, I think they've helped save the country and postpone collapse at least for a number of years.
No, I definitely have, and it's going to be booming for quite some time. We're just in the early innings of developing these plays. Believe me, they're going to downspace. They're going to start drilling stacked wells. In the Eagle Ford, there'll be hundreds of thousands of wells drilled in the Eagle Ford. and that's a 7 million acre area. Then you go to the Permian Basin, it's been producing since the 1920s, and it's still going. The Permian Basin is 19 million acres. It's huge. It's big. It's bigger in area than the Bakken and the Eagle Ford put together.
Yeah, and the Eagle Ford also extends to Mexico too. So if Mexico decides to open up, you're going to see some of the same guys that are drilling the Eagle Ford, right? They're just going to cross the border, right, and go and do the same thing that they're doing, for less money then, because the Mexican government's going to take a lot more of a cut than probably the U.S. would.
What's amazing, you go down there to the Texas border. If you get a map of the Eagle Ford, you'll see that it looks like it stops right at the Texas-Mexican border. Well, it doesn't. The geology goes across the river. And there's all these rigs drilling on the U.S. side, but there's no activity at all on the Mexican side. And here's a country that, is just starving for economic growth, and, nothing's going on there across the river. I guess they're too busy, selling drugs or something to focus on their energy business. They need it because their energy production is going south.
Yeah, exactly right. Pemex had the Cantarell field, and they didn't reinvest nearly as much capital into keeping production and reserves at constant levels as a national oil company. Their politicians starved the company of a lot of capital, and they've just lived basically off that one super major field that was discovered, I think, in the 60s or 70s.
Right.
And, their shale plays are in need of a lot of capital. They have a lot of deep water offshore, too, in the Gulf of Mexico. That area hasn't been drilled either. So I think there's opportunities there in Mexico. Hopefully they open up just like they have with their mining, because Mexico has great geology for mining for, like, gold and copper and silver and things like that.
Right. People ask me, too, aren't these shale plays all over the world? Well, I went to a long conference. There's an Australian-American group here, and they have a big conference, 3-day conference here, and I went to it. It's Australian companies doing business in America and American companies doing business in Australia. And they've got some very high-quality shale in Australia. But once you get off, the whole population lives in that southeastern corner, I think. The rest of Australia is incredibly remote. And by it doesn't even have road access, much less pipeline access. And so the upfront capital.
Or electricity.
Yeah, or electricity. They have nothing. So in order to develop those, you're going to have a massive amount of capital spent on infrastructure before you can develop them. And that truly is the reason why the Eagle Ford, like in Texas, ramped up so quick, is because there was already a lot of producing zones. Because the Eagle Ford is the source rock for all the zones above it. And there's 12, 14 zones producing above the Eagle Ford. And so there's already a lot of production, already a lot of wells, roads, pipeline connections. And, it's pretty good weather down here, so it's wide open territory. And they could get in there really quickly and start developing. And then it's darn good rock, too.
Now, in terms of other shale plays here in the United States, we've talked about the Eagle Ford, we've talked about the Bakken, we've talked about the Permian. Do you think the Marcellus or the Utica are the next big shale plays? Do you think there's going to be good oil finds there, or do you think those are mostly like natural gas plays?
Well, the Marcellus is the world's largest known natural gas resource play, and it's really what's great about it. It's close to the biggest market in the world, which is the Northeast manufacturing market up there. Sitting underneath it is the Utica, and the good stuff is more to the east. So in the eastern maybe quarter of Ohio is where the really good rock is in the Utica. You're going to hear a lot more about the Utica this year. Watch companies like Gulfport. They're drilling some really good wells over there. Carrizo has got some good wells. Carrizo is symbol is CRZO. Gulfport is GPOR. Good solid companies, and they've got it going over there in the Utica. And the one problem is they've had to wait for the midstream companies to catch up to them, because the right of way, getting right of way out in West Texas with a West Texas rancher who can't wait to cash that check for his right of way. Over in Ohio, you've got the problem of the acreage is divided up a lot more. People that aren't as familiar with the oil and gas business working it.
Yeah, that sounds like a lot of growth potential. And the thing with natural gas is we have to put the pipelines in place to get it for when we're ready to export LNG in 2015, 2016. And entrepreneurs, like either with new CNG engines or the Pickens plan, which I think is good, but I don't think the politicians want to implement the Pickens plan right now. We're going to have to figure out new innovative ways to use all this cheap natural gas. and it's just going to be investing opportunities there. I know you don't really cover the midstream and the innovative natural
Well,
gas.
we cover midstream companies in our MLP. We have an MLP watch list.
Oh, okay.
We have a lot of MLPs in our high yield income portfolio in the newsletter. And yeah, the midstream companies are fantastic investments, and they're solid, and their revenues are locked in by long-term contracts. So yeah, you can put together a portfolio of midstream companies and MLPs and get tax-deferred yields in the 7, 8, 9% range. They're really good. I'll tell you another one to look at. Look at some of the frac sand companies. Look at the charts on High Crush Partners. It's HCLP. I think it's up about 250% this year. They sell frac sand, and they have frac sand mines up in Wisconsin. And the price of frac sand has just tripled in the last year. And all the E&P companies I'm following are talking about using more sand per well, that they're getting better results based on how much sand they use. And another one is Emerge Energy Services. That's EMES. And it's structured as a partnership, as a master limited partnership. MLP trades on publicly. And these companies just have had incredible growth in the last 12, 16 months.
Yeah, and I covered MLPs for a while when I worked at Investing Daily. I worked on their MLP Profits newsletter. So there's really good – MLPs are arguably, I would say, the safest yield investments on the entire stock market because I view oil and natural gas as consumer staples. I don't think they're discretionary. People want their homes heated or cooled in winter or summer, whether it's in the winter they want their homes heated, and in summer they want air conditioning, at least in the United States. And people want transportation. They don't want to wait. Most people, if they can afford it, they don't want to wait on a bus or things like that. They want to drive their own car to work or carpool or things. So I view that as a consumer staple. So I think demand for that is very strong. I don't expect it to drop off in the developed world. In the developing world, demand for oil and natural gas is growing like gangbusters.
Oh, yeah. It's incredible. If you go to the EIA website, if you look at their forecast demand chart and their forecast supply chart, you go, wait a minute. These things they're not to the same scale. when you put them on the same scale, you quickly see that their demand chart is above supply. Well, Jason, you and I know on a commodity, our demand cannot exceed supply for very long because there isn't that much storage. There really isn't that much storage of oil and gas above the ground. So if you don't have the supply, what's going to happen is it gets rationed by price. And that's what's happening today. That's why you have oil at $100 a barrel.
Yeah, exactly. And we're not seeing as much investment or as much exploration success outside the United States.
Sure.
Because CapEx is so much higher. The CapEx has increased, the CapEx has gone from $300 billion a year in CapEx globally for oil, I think in 2005, and now it's over $600 billion per year just to keep oil production basically flat globally.
Yeah, I saw a chart that says that this year, 2014, they're projecting that there'll be $1 trillion in CapEx spent in all of energy. And that includes infrastructure and everything, not just E&P. But it'll be the first time we've exceeded $1 trillion in capital. And that's incredible for the economy. I mean, what other industry is spending $1 trillion?
Maybe healthcare.
Yeah, maybe healthcare. Yeah, who knows? But it's pretty good times. I've been in the business for 30 years, and I can tell you this is the longest period I've ever seen where it's been this good for this long. And you mentioned the midstream companies. I have never seen it this good for the midstream companies. They're building incredible.
Yeah, they're building those pipelines, and they're basically like toll companies. So they're charging the oil and natural gas companies to run the stuff through,
right.
And they're not taking a humongous amount of risk except for actually building out the pipeline because they're making sure that there's enough supply to go through the pipe, and that's basic. And they're just making sure there's not leaks or explosions in the pipe. Right. It's a fairly safe business model, I think.
Yeah, it's a really good business, and they've been around for a long time. I mean, if you look, one we like that there's just an incredible American success story is Plains All American Pipeline. Their symbol is PAA, and you look at the growth that thing's had over the last 10 years, just a tremendous American success story. And there's a lot of them based in Houston here.
Yeah, Houston's right at the hub. Yeah, for our listeners out there, you're based right in Houston. You have some of the best oil and gas contacts. Not all energy newsletter writers are based in Houston, but you're right at the center of everything. And I'm looking at your newsletter now. You have a lot of good returns, a number of winners over the long term. You have a really good, successful portfolio of different stocks of different sizes. So you have your Sweet 16, which are still growth companies, but more larger, established, independents or mid-tier producers, you would call them?
Mm-hmm. Yeah, they go up to EOG Resources, which is about a $50 billion market cap, and then the smallest ones are like a couple billion market cap. To get in the Sweet 16, it has to be a minimum of $1 billion market cap, and it has to have confirmed 10% production growth and reserve growth. So at least double-digit production and reserve growth. And that's pretty much the same for our small cap growth portfolio. We actually have some companies in there that are up to $4 or $5 billion in market cap. We also have some companies that are, the 200 or 300 million market cap. I mean, I can give you a long list of companies that started out that small that are now, multinationals right now,
or got bought, for big premiums probably.
Yeah. Hey, when I started at Hess, Devon didn't even exist, and now look at the size of that thing. It's about a 30. I think it's about 30 or 40 billion market cap company.
Well, that I like to say, Dan, one of the ways you get rich is finding a somewhat profitable small cap company, making sure the management's good, they can generate free cash flow, and then you basically just stick with them for a while, and either they'll get bought or the management team will adapt the business strategy and continue to grow. That's and I think your small cap portfolio looks like it has. I don't know if you had a chance to look at the oil report I sent over that I co-authored in 2012, but we have some of the same small cap oil producers in there too. So,
yeah, great. Yeah. I just got into it. I just read the first couple pages of it. I didn't have enough time because all these second quarter earnings reports are just pouring out, and I have to update my models as fast as I can. But I agree with you, man. This is the place to invest in. It's tremendously profitable. The net backs of these companies now in the 45 to 50 per barrel range is incredible. So.
Yeah, I think the next 3 to 5 years for a lot of these junior oil producers, mid-tier producers, I think they're in a real good sweet spot, and the market, like in general, is just not really valuing them. A lot of regular value investors they don't like resource stocks, so there's still good contrarian bargains there. Undervalued growth stocks there in oil and natural gas, and I allocate a good amount of my portfolio into oil and natural gas, and I like it a lot long term.
Mm-hmm. Yeah, there's always a market for the supply. The producers may not be that happy with what they get for it sometime, but you can always sell everything you produce, and it's a commodity with a tremendous market out there.
Yeah, and the thing about oil is it can be stored a lot easier, whereas natural gas is a little more difficult to store right now. The U.S. LNG market may solve some of those problems going forward, but oil is, very well-established market, and they have a lot of storage options for it. Now, Dan, in wrapping up this newsletter, please tell our listeners if they want to check out your newsletter, which website they can go to and how they sign up and things like that.
Okay, the name of our group is the Energy Prospectus Group, and it's just energyprospectus.com. on the website, and they can click around there and look, and actually they could go to our forum and see what we discuss. We have a chat room called the EPG Forum, and we're actually right now, discussing a lot of these companies out there, and they can read it. You have to be a member in order to post a question, and then, of course, you have to be a member to see all of our published reports. We publish a newsletter called The View from Houston every 3 weeks, and then we publish individual profiles on over 100 companies a year. And we are not compensated by the companies at all. It's our membership dues is what keeps this thing going. But we are not compensated at all by the companies, and so they are our unbiased view of the company and my unbiased valuation. And I am valuing them more on what I think their takeover value is or their breakup value is, which is a little bit different than a price target. But it's really been proven over the years because we've had dozens of our portfolio companies that have been taken over since 2001, and they've almost all been taken over at what our fair value estimate is. In fact, Whiting took over Kodiak Oil and Gas, and the price they paid was almost to the penny what my valuation was.
Maybe they subscribe to your letter.
Maybe they do. Actually, we have a lot of analysts that subscribe to our letter, and sometimes I'll see an analyst report. I won't name the firm, but sometimes I see an analyst report that's almost exactly what we said in our profile.
Okay, well, very, very good, and you're right out of Houston, so you're right at the heart of the oil and natural gas industry here in the United States. So I think that's good, and you have a very good contacts list because we know some of the same people, and you came very highly recommended, which is why I interviewed you. So thanks again for your time, Dan, and I definitely want to have you back in the next couple months for your views again on the oil and natural gas markets.
Okay, I appreciate it. Thanks.